Good morning, everybody. I'm Rob Engel, and welcome to the QFE at NYU. We are very fortunate to have Matt Richardson, who's going to speak today. The organization is that he will talk for about an hour, and we'll be happy to take questions as you go. So you just can either put them in the chat or maybe raise your hand. And then after the talk is over, we will have a sort of a 15-minute sort of friendly session time to talk about whatever seems relevant for understanding the paper and its extensions and anything else that might be interesting. We do have a one final QFE for the fall, which will be Gernot Wagner, who's going to speak on December 7th. He's actually become quite a famous columnist for Bloomberg, and writes a column on risky climate. So he's going to talk about some of the climate research that he's been doing with Bob Litterman and Kent Daniel. So today we are very happy to have our own Matt Richardson talking about the systematic risk of global asset returns in times of crisis. And in particular, how's COVID different, and how has it been different since Monday? Or whenever the first vaccine was announced, and all those things that are just changing so incredibly fast in this world. So thanks, Matt, and the floor is yours.
Well, first of all, we're going to have to update the data because we don't have it till for the last few weeks. But this is joint work with Kobe Baduch at IDC and Yukon Liu at University of Rochester and Toby Moskowitz at Yale. And we've been kind of interested in this topic, not sort of the COVID topic, but this topic for several years. You know, thinking about when you take a global asset return and you want to think about how it relates to global factors, you know, what drives that relationship? And it can change because the variance of the factor is changing. It can change because the loading on the factor is changing. It can change because the idiosyncratic risk of that asset return moves around. But it can also change because the factor itself is dynamic. If you think about the S&P 500, now where it was 6 months ago, and what makes up that S&P 500, it's a different assets, so different factors. So that was sort of kind of the original, that was kind of a motivation. But we hadn't, we get busy and we hadn't really, other than with exchange rates, we hadn't really sat down and kind of done the work. And then when COVID-19 pandemic occurred and so many people in economics and finance were really trying to get research out quickly and thinking about what was going on, we thought this was kind of a good way to sort of get back into this topic. So the motivation is really, how does the factor structure of global asset returns kind of change through time? And, beyond what I just said, there is kind of this literature out there which sort of argues it's kind of a low dimensional factor space. And that's on one end. And on the other end, when people look at equity, fixed income, exchange rates, many of these papers are theoretical, but they have an empirical section. There's a feeling that they don't really span each other. So that, those are three asset classes to kind of look at. And that's what we do here. We sort of look at those three asset classes, and we're going to develop the factor structure and then see what's happening through time. But in particular, we're really going to focus and dive into the COVID-19 global pandemic. And we're going to start with January of this year through the end of June. As Rob said, we need to update it, not just because of the vaccines becoming available, but also because obviously the virus itself has sort of exploded again, both here in the US and sadly also in Europe. So we're going to update the data at some point before we kind of close off the paper. one thing that I think we all lived through in March, late February, March, and April was just a massive amount of volatility in the global asset markets, big swings in valuation. So it's kind of an interesting, uh, it's interesting thing to look at in terms of sort of the underlying factor structure. Did it change, or was it just volatility, or just movements in variance, for example? And then what we're going to say is, look, once we've done that, once we've sort of figured out what's going on with the factor structure, what does that mean for portfolios? So investors, we hold portfolios, and we hold them in normal times and in crisis times, and in particular in this period. What implications does that have for these holdings? And so we're going to get a few kind of interesting results. Maybe not surprising when we think about it, but it's good to document. So that's the idea. Now, in terms of the actual outline of the paper and today's talk, we're going to do three things. We're first going to describe to you how the factor structure changes through time. And our analysis is a little bit novel to the literature here. We're going to use high frequency data over the last 14 years, including this year, on 24 global assets that have either futures or spots covering equity, fixed income, and exchange rates. And we're going to pick the big markets, the one you got good data for one reason, but also they cover most of them, the market values out there. The exception, of course, is China. There's not good data, not futures data on China. So China's out. But other than that, we've got the rest of the big markets. And then we're going to use a principal component analysis from the high frequency data variance covariance matrix to construct the first two factors. And then we're going to describe to you what those factors look like through time. And as I said, our big focus is really on COVID-19 period. And so we're going to zoom in and investigate what's going on during this period. What's different about it relative to quote unquote normal period. And then, we're going to find there's a pretty big structural change in the factors empirically. And then the question is, how do we know it's really COVID-19? How do we know it's just not something else? In deduction might suppose that it is COVID-19, but we want to kind of sort of try and prove that or provide evidence that that is going on. So we do a novel analysis here, two kind of interesting things. We take our PC factors, and then we're going to relate that to COVID-19 shocks, COVID-19 news. And we're going to do that via unstructured text. So we're going to use textual analysis to back out news about COVID-19 and relate that to the PC structure. Secondly, is we're going to take forecast errors from an epidemiological model of COVID-19 deaths and relate those forecast errors to the global factors as well. And one thing we're doing here, there's a few papers out there in finance that are sort of using forecast errors for models and using textual analysis. We're not going to use our own textual analysis or our own forecast errors. We're going to take that from kind of leaders in the field because they just have much more resources. So that's a little bit of a different. The data we're going to look at here hasn't really been looked at so far. So that's an interesting analysis that I hope you'll find of use. And then the final topic is we're going to look at the systematic risk and what it means for hedging for global asset portfolios. And we're going to pick 7 portfolios in particular. We're going to take equal weight of dollar-denominated equities across countries, an equal weight of dollar-denominated fixed income, an equal weight of foreign exchange against the dollar, risk parity, where you sort of weight by volatility across all 24 assets, a minimum variance portfolio from kind of Markowitz, and then 2 examples of strategy style portfolios with momentum and value, and see what we're going to get here. Actually, in the talk today, I'm really just going to focus on the first three, the equity, fixed income, FX, but the paper sort of goes through all seven. So that's the idea. So first, the data. What does the data look like? So we have minute-by-minute prices on assets that capture, I would say, most of the global markets. We have 10 equity futures, the big countries. We have 8 fixed income futures on 10-year government bonds, and we look at 6 spot exchange rates that are related to our equities and our fixed income. We also have 4 commodities. We don't do much of it yet, but these are sort of supposed to capture sort of underlying economic conditions. So things like crude oil, which is energy, or copper, which is kind of industrial, or corn, which is kind of agricultural, and then gold as kind of a safety asset. We're gonna, as I mentioned, we estimate the high frequency return correlation matrix and return volatilities. We aggregate the minute by minute to 5-minute intervals. We're pretty careful about matching across markets. So to make sure that when we do the covariance, it's consistent with the timing. We also ignore periods of market closure in calculating the correlations, which is, so we don't look at overnight. But as you'll see, unlike papers that have looked at equity markets, so there's a big literature that's looked at the return correlations of high frequency in equity markets. Here we actually have a lot of the time we have 24-hour coverage, which is kind of unique. And then when we build up the variance covariance matrix, we actually do incorporate the overnight, because that does represent, so the volatility does incorporate that, albeit, you know, not very efficiently, because we don't have the minute by minute data. We're going to perform a principal component analysis using the high frequency correlation matrix. H. Sahali and Chu have a bunch of papers doing this, both justifying it theoretically and actually implementing it. Our implementation procedure is a little bit different. I won't get into that here, but it's kind of discussed in the paper. But the basic idea is we want to sort of every 2 weeks throughout the sample from 2007 to 2020 of 14 years, we're going to provide you what the first PCA factor, first principal component and second principal component look like. And then we're going to try and understand, you know, why it looks that way. So that's kind of the novel part of the paper, is that we've got these global assets all across the world, and we're going to tell you how their correlation, what maximizes their correlation structure, what 2 factors do that, and how those factors change over that 14-year period every 2 weeks. One, of course, interesting thing that is going to be so obvious and not surprising given we lived through it, is that the news about COVID-19 was so fast moving. So when you look at the bi-week high frequency data during that period, it just becomes very, very plain, you know, how wild and crazy that period was in sort of the global financial markets, and that will kind of jump out. Captures of the data. So again, I'm not going to show that here, but it is in the paper. You could imagine trying to do something using daily return data as opposed to high frequency data. And it just, you know, not surprisingly, daily returns are just way too noisy to construct fast moving variance covariance matrices. And we actually give some examples in the paper of how that doesn't really pan out. I see Yakov has a question. Sorry, Yakov, I missed that. Can Yakov ask a question or no?
Yes.
Oh, yeah.
What do you get qualitatively by having the high frequency data as opposed to daily data? So I see you have a slide on that.
Oh,
you
yeah.
need to have correlations which naturally change over time.
Yeah, but, so it turns out, so this is an interesting question.
No, let me finish. So suppose you took Rob Engel's model of dynamically changing correlations using daily data. Could you, I mean, I think it's an interesting question in itself. Suppose you use his model of changing correlations, daily changing correlations, as opposed to your high frequency and see whether qualitatively you get the same results?
Yeah, so that's a good question. So we haven't done that. So we haven't done DCC using daily data. Obviously, the benefit of DCC is that because it's structural, you don't need all the observations to estimate the parameters to get kind of tighter estimates. But you still need a fair amount of data using daily returns.
Right.
So to capture, the changing, weekly, it's an interesting question. So we're not doing that here. So we're in some sense every 2 weeks doing kind of an unconditional analysis, and daily returns are just way too noisy. So that's kind of what we show. They're not really useful. It's funny actually, if you look at volatility, daily high frequency doesn't buy you that much relative to daily because of the properties of volatility. For correlations, it does. You just cannot estimate correlations using daily data. But that's not to say Rob's method wouldn't give us something similar. It would definitely be worth exploring.
Thank you.
Yeah. So one thing I mentioned, compared to stock data, which goes from like 9:30 to 4 p.m., that you have in Eitzahali and Chu, for example, in some of their earlier work, they look like part of the global financial crisis, for example. We have really pretty good coverage over 24 hours. So what we have here on the x-axis, we've got the commodities, equities, fixed income, and FX. And then on the y-axis, we have 12:01 a.m. to 1 a.m. Eastern Standard Time, 1 a.m. to 2 a.m., all the way down to 11 p.m. to 11:59 p.m. in the final. So we have all 24 hours. Where it's dark green, we have total coverage. When it's like gets to a lighter green, it's not 100% on every period. Perhaps the market was closed for that period. There are a variety of things that could be going on, or data is missing. And then it goes down to where we have no coverage when it's like white or zero. And what you can just sort of see is there are a lot of these markets, even in fixed income, some of the markets have pretty good coverage over this 24-hour period. And the paper does sort of an analysis about whether the overnight versus the within day periods, whether they sort of match up. So they match up pretty well, good coverage. So I'll just kind of move on from that. Now going to the risk factor structure. Here is just an example. This is the 2019. It's so last year, fourth quarter, what we did is we took the bye weeks and we averaged the bye weeks over that quarter. So we averaged sort of 12, 13 weeks during that fourth quarter. And in blue, you have equity, red fixed income, and green FX. On the x-axis, you have the loadings from the first factor, and on the y-axis, you've got loadings on the second factor. And I picked this 2019 because it's pretty representative of the sample period in terms of sort of what equity, fixed income, and FX looks like. The first thing you see, and that's just probably not a surprise, given the correlation structure, is that it clusters, right? So the first factor or the second factor, have sort of a cluster of equities with similar weights. The fixed income has a cluster of similar weights, and FX a little bit less so. It does turn out that Japan, the yen, dollar, and sometimes the Swiss, you can see here, is a little bit on its own. Now that's probably not, may not be surprising because the yen has these very different properties. It's like the funding currency for carry. It's often viewed as there are many papers about it being a safe haven. So it has a little bit like a fixed income quality in terms of the correlation structure. But that's sort of what you sort of have. The first factor looks like long equity, short fixed income, maybe short yen, and sort of neutral elsewhere. The second factor is long fixed income, like mild position in equity, and kind of short FX. And that's sort of what the factor structure looks like. Now, I will say that it does change through time. And there are times when it sort of has spikes. And so this is the PC1 from 2007 to 2020. The red dotted line here, that's the beginning of the COVID period. And we have both PC1 and PC2. You can see that the PC1s are a little bit, don't change as much. PC2, there's quite a few spikes. There's actually an interesting drift in FX in the second PC2 factor with wild moves, as you can see, during the COVID period. And you can see there are spikes. There's a spike here, here, here. There's a spike, early there, another spike there, etc. And it turns out that these spikes do sort of coincide with crises. So these factors are changing through time, but they also seem to change during crises. And I'll talk about this at the end, but we've done the same analysis for the global financial crisis and for Brexit. And there were some similarities to the COVID period, but there were also some kind of differences. One question would be, how does this, let's try and get a measure of how the factor structure changes. So what we look for is, imagine that you took the weights from the previous quarter and you have the weights this quarter on each of the assets in PC1 and each of the assets in PC2. And then we're going to take those change in weights, times it by the return over the current period, and we're going to see whether we're going to calculate the absolute value of that. So we're going to sum over the change in weights times the returns in the period and see what happens. If the weights don't change at all, then that number's 0. So that's a necessary condition for you to see a big change in this value. But also, if the weights do change quite a bit, but there's no volatility, if returns aren't moving around, then you're also not going to see a big change in difference. So you sort of need to see a change in potentially in the volatility or the variance covariance matrix of returns, as well as a change in the weights. And this is what it looks like for our period from, again, 2007 to 2020. I've signaled here the Brexit, COVID, and global financial crisis dates. And you can see the big change in factor structure, at least through this measurement, is on those crisis periods. And in particular, the COVID period had the largest spike of any of these events over the last 14 years. One other thing to point out, which is going to be a little bit relevant when we relate it to COVID news, is we've normalized all the values here. So you can compare the change in factor structure for PC1 and PC2. You'll notice it's about 4 times higher the scale for PC2. There is just a bigger, normalizing for the variance. There is just a bigger, more going on with PC2 than PC1. And that's going to be important when we relate that shortly to COVID. We can do the same thing for factor volatility. So we can calculate the PC1 variance, PC1 volatility, and PC2 volatility over this period. And here it is. And again, this wouldn't surprise anyone who was obviously paying any attention in March and April of this year. But the volatility of PC1 and PC2 is the highest during the COVID period. And again, you've got this global financial crisis spike and a little bit of a spike here with Brexit. Volatility of PC1 is about 3 to 4 times that of PC2. Not surprisingly, because as we saw, PC1 has a big load on variance on sort of equities, as well as a short position fixed income. So it's not surprising that it has a higher volatility. Just one final comment. I'll just say this very briefly, and then I'll answer Yakov's question. We relate the R squared, we take 4 commodities, copper, oil, corn, and gold, representing different parts of the economy, and we regress that on PC1 and PC2, again, using high frequency, so using theoretical betas you back out of the variance covariance matrix. And we also look at the betas of these commodities. And, you know, it's a bit noisy, it's a bit bumping around, but one thing you do kind of see that does show up is that copper, corn, and oil, which kind of surprised us. I don't think we expected it necessarily. Their R squareds jump up. The R squared of them on systematic factors jumps up during these crisis periods. So there's a link between what's going on in kind of the economy and what's going on in these financial markets. It's not just, you know, markets moving without relationship to the underlying economy. Interestingly, gold does the opposite. So gold actually is a little bit weaker. Gold R squared drops during sort of some of these periods. So it's the relationship between gold and the systematic risk actually changes. We did not expect that ex ante. So that's just you know, one quick comment on these factors. So I've got a couple of questions. So Rob, you asked if you used 3 components, would FX cluster more? Good question. So we do have, you know, PC1, PC2, and I will say the difference between PC2 and PC3 in terms of contribution to kind of the scree plot, whatever, in terms of the how much the variation explains, is not that big compared to the difference between PC1 and PC2. We just stopped the analysis a little bit because we wanted to show these graphs, as you'll see, between, you know, 2 dimensions. So we kind of stopped it at 2 components. So I don't know what the third component would, what it looks like, but it's possible the third component, you might have more clustering there. Yakov? You still the question, Yakov, or?
Just clarification, 2 questions. One is the bonds are government bonds?
Yeah, 10-year governments.
Okay. And second question, everything is in common currency, like dollar?
No.
So
the exchange rates, you're going to see at the end, when it goes through the portfolios, they're dollar denominated. But the FX is against the dollar, but the
equities and bonds?
The equities and bonds are in their own currency, just because it doesn't matter because we have 24 assets. So, you know, we did it
sure? I don't know. Would it make a difference if we dollarized everything?
I think well, you'll see. Let me hold on. You're going to see portfolios where we've dollarized the equity and fixed income, and you'll get a look at that. So maybe I can talk about it then.
No, because implicit in your factors, then there is also like equity or bonds. You have also the effect of exchange rate.
Yeah, the effect of exchange rate. Yeah, but we have exchange rate in there.
There. I mean, implicit.
Yeah. Well, explicitly we have exchange rates in there.
Yes, I know, but in addition,
you're right that the exchange rate and the fixed income may correlate because they're in different currencies.
Okay.
So this was now we're going to go to COVID. We're going to go to the COVID period. This was what we saw a little earlier. This was the 4th quarter of 2019. Now, this is the first bi-week of 2020 when the virus first showed up in China. Nothing going on in these 24 markets. They look very similar to what we saw just a short while ago with the period in 2019. And the second bi-week looks kind of similar. Third bi-week, you know, maybe a little separation of FX, but again, looks pretty similar. And of course, late January was when the virus had clearly shown up globally. But at least with the factor structure, not a massive change. By week 4, similar, except one asset now breaks from the pack and goes out on its own. And that's Italy Italian fixed income, which is kind of interesting. So that's kind of interesting because February 23rd was when Italy went into lockdown in northern Italy. They locked down. And in fact, this break from the pack never comes back. So even as you'll see things begin to transition, that fixed income and Italian bonds is always now on its own. So the relationship between Italian bonds and the rest of the markets, that changed during this period and continued that change. Dick had a question about term structures. That would be a good thing to look at. We did not look at that. So that would be interesting if we also got data on the short end of the yield curve for these countries and sort of included that in the picture. We did not think of that. So that would be an interesting question. So his question was about could a next step be to look at term structures of these relationships? So look at the term structure of long-term and short-term bonds. That would be, and whether inversion versus upward sloping. That would be an interesting question in general. Okay, but by week 5, February 26th to March 10th, all hell, as I mentioned here in red, breaks loose. Right now we've got fixed income. We've got equity and fixed income are still long short, but FX now has gone sort of negative loading. On the PC2, fixed income is no longer positive loading. It's now flat. And FX has gone, for many of the exchange rates, very positive. Big change in structure. You're going to see some data documenting that shortly. So something happened in that sort of first 2 weeks, end of February, early March, where we know what happened. We were living through it. We were all debating at the end of the first week whether or not, or going to the second week, whether we're going to sort of leave New York City and go elsewhere. The virus showed up March 5th in New Rochelle, and it turned out the guy who had the virus, everyone he got in contact with got the virus, and it was spreading all over the place. So that was a big move in markets, and also obviously a lot going on in the coronavirus. The second week, by week 6, okay, now it looks a little bit like it did before, maybe, except Italy and France are on their own now. Of course, we know France was getting hit around that time, but now FX has changed. FX has gone from negative to positive, like we just saw in the previous graph on FX, and you see it even more so by week 7, that went from the end of March to April, with Italy again on its own. By week 8, you're beginning to move back to normal, right? FX is dropping. Equity fixed income is looking a little bit like it did before. By week 9, again, on that path, except for Italy. By week 10, again, in that direction. By week 11 now looks almost, other than Italy, looks almost exactly like you had in the earlier bye weeks. Then all of a sudden, by week 12, oops, it fires up again. And you go, why by week 12? What a weird thing. And you'll see by week 12 shows up a lot in some of our results. Well, of course, that 2-week period was the period in which, prior to that, the virus, the number of cases in the US had been declining. And during that 2 weeks, they began to increase again. Around, people blame Memorial Day. that had happened in kind of mid to late May. But again, that, showed that we don't have a handle on it. And it apparently, had an impact on the markets, although by week 13, it went back to normal again. So it's a really strange, just a 2-week period when the factor structure looked like it did before. So that's just sort of a time series of the changing factor structure. What about some actual stylized facts? So if you looked at the mean of PC1 and PC2 during the COVID-19 period, so during the 7 months of 6 months of the of 2020, PC1 is a minus 54%, and PC2 is about 1.7%. The standard deviation of PC1 is 142% and 41 for PC2. So that kind of looks like, right? That looks pretty risky. That looks like a pretty, we've identified a risk factor, right? So this global risk factor, that's kind of what you'd expect if things are going to pieces. It would be awfully, loading on high on that PC1 would be bad news, right? So that's kind of a sort of interesting result. In the PC1, we highlighted weeks 5 through 7. That's the incredible amount of volatility that occurred in PC1 during that period. And PC2 also, massive jumps from the earlier bye weeks during that peak of the period. And an interesting thing to think about is we take PC2 using the COVID weights during that period and PC2 using the normal weights from the 2019 fourth quarter period. And we correlated the returns. So the exact same returns, just different weights. Doesn't make a difference on PC1 because the variance is driving everything. But PC2, you see the correlation actually go to almost 0 by week 7. So there was a massive change in weights in the PC2 structure coming from the COVID period. Interestingly, even when we've got back to the kind of the normal period where the weights look pretty similar, the variance, the standard deviations, even though they're down quite a bit from that peak period, they're still way above what we had prior to that period. So there's elevated volatility in the PCs. Just as a final comment, if you do formal tests of COVID versus normal period, either looking at that analysis we had before, look at the absolute differences in the PCs, or just looking at the difference in loadings, they all come up significant. So even though PC1 didn't obviously change as much as PC2, from a statistical point of view, it still looks different than sort of the average, what you would find in a normal type period. So that's just summarizing the information I just described. The variances. So one thing we wanted to think about is when the variance of the PC changed during the COVID period, is that because of the changing variance covariance matrix, or is it because the weights are changing? Obviously, these are not independent questions, but anyway, we plugged ahead anyway. And what we did was we took the difference of the variance of both PC1 and PC2 over from bye week to bye week, and we broke that into what we call changing variance covariance matrix by artificially holding the weights constant and letting the variance change versus changing the weights and keeping the variance fixed. So this is just an identity, right? I'm just breaking this up into an identity. So it's mathematically equivalent. They're not, as I mentioned, they're not independent, so it's not totally kosher, but we thought it was worth kind of looking at anyway. And this is what the change of the PC1 variance looks like. Obviously, it's massive over those weeks 5 through 8, right? So everything else looks tiny relative to that period. That's where the big action is. And if you looked at PC1, in yellow is sort of the part of the variance due to the changing variance-covariance matrix, and in blue is the part that's due to changing weights. And you can see almost everything throughout the COVID period from week 1 through week 12 is really coming from the changing variance-covariance matrix, albeit something came from the weights. We did see weights change during that period, so some of it's coming from the weights, but it's primarily coming from variances. You'll notice week 13 is different. The reason week 13 is different is there was that weird behavior in week 12, right? There was that weird, the weights change back to the week 5 through 8, and then it just changed back again. So that's clearly changing weights. There wasn't a big change in the volatility of the PCs. It was really the weights went through this kind of big shift and for some reason came back down. PC2 is a little different. So same story for PC2, week 5 through 8, but now you've got these kind of offsetting effects. Like you get a big change in the variance, but you're also getting big changes in the weights. Again, they're not uncorrelated. That's why you're seeing one go up, one go down. But nevertheless, it's sort of kind of interesting to sort of see that the weights were changing quite a bit during that period. So difference for PC1 and PC2 in terms of sort of the changing factor structure. So that's a little bit about what went on in the COVID-19 period with PC1 and PC2. And then the question is, was this due to information or news about COVID-19? So what we decided to do is let's take the PCs, the information of the PCs, and let's try and relate it to shocks, COVID-19 shocks. And I'm going to describe to you the shocks in a second. And then we're also going to relate it to shocks coming from forecast errors from epidemiological models. So the first thing we do is we use a company called Ravenpack. Ravenpack is a kind of commercial vendor that kind of measure events and sentiment, and that's captured in unstructured text. And they use kind of natural language processing algorithms. They're kind of maybe the leader in this area in the asset management community. So they sell to the asset management community. When the global pandemic started, sort of as a service to the community, they did the initially for clients, and then they made it available broadly, was for each country and worldwide, they construct daily news indices on COVID-19 news. And they have different indices. One's called panic, one's called hype, one's called coverage. We deseasonalize the index because it turns out there's a pretty big seasonality from day to day because they're getting it from media text. So the weekend's different than the weekday. And we construct a composite index. And this is what it looks like over the COVID period for, we've normalized it. So it's going to be, in terms of the composite index, we've sort of normalized it to be roughly between -2 to 2. And you've got 10 countries here, and you can kind of see things that kind of make sense. The first country that reacted was in kind of mid-January, and it was Japan. Japan was in Asia, close to China, and therefore had a reaction. Then at the end of January, you get news, because now then it's showing up in the US and around the world. And then you kind of bop around during February, and then you get this massive spike at the end of February. That's Italy, right? And then you've got countries catching up to Italy, and then you've got this slow drift down during June as countries began to sort of get a handle on the virus. So you have here, a sort of a timeline that kind of matches what we think of the big events, but you've also got perhaps a cross-section, which is kind of interesting that might be able to give us some information. On the forecast error front, there are two kind of leading epidemiological groups in the world. One's Imperial College, and one is IMHE at WashU. You've heard about these on the news because they provide long-term forecasts. In fact, Imperial College is famous because they're the ones that came up with the 2 million people are going to die in the US without mitigation, which allowed our soon-to-be former president claim he saved 2 million lives through his actions. And then the IMHE one is, is named every day on CNN about how many deaths are going to happen by January, February. So they're the main firms. They started doing this on infection and death rates, basically starting in pretty early on in the crisis. They have very different approaches. So the Imperial College one uses kind of a more formal modeling, SEIR type models with data, where IMHE is really curve fitting and more a kitchen sink empirical type model. And so they disagree quite openly, publicly about which approach is better. What we're going to do here is we're going to take one particular set of Imperial College's forecasts, because long-term forecasts aren't really available that frequently. They do provide 1 week ahead forecasts for 69 countries starting in mid-March. And so what we're going to do is use that data and data about factor returns to see if we can link the two. This is what it looks like. We just produced 4 countries here: Japan, the US, Italy, and Germany. And you can see at each date, there's these red dots. So the first dot is the 1 day ahead forecast, second dot 2 day ahead, third dot 3 day ahead, 4 day ahead, 5 day ahead, 6 day ahead, 7 day ahead. And then you could imagine you sum them up, that gives you the forecast over that week. And then the blue line is the actual deaths according to the ECDC. That's a European version of the CDC, and that's the one that they're calibrating their models to. And you can sort of see some examples here. You can see that the forecast increases, not Japan initially, then decreases as Japan got hold of it. The US, it increases, then decreases. Italy increases, and then same with Germany decreases. But there's timing is different cross-sectionally. So they have different timing cross-sectionally, which we're going to exploit. And it's also, one thing is they were kind of pessimistic. So they, perhaps didn't realize we had better medical care, or perhaps they misunderstood the distribution of the population, or that there was going to be more mitigation for older folks in the population. So they've been sort of wrong, a little bit more than they've been right in the forecast errors over this period. But generally, not surprisingly, because 1 week ahead, you've got lots of information about infections, about the distribution of the population. So you should be able to get pretty tight results, and you'll see that they do. So first thing we do is we take our PC1 and our PC2 and together, and we regress that on the shocks to the worldwide index of news. The change in the index we're viewing as a shock, as a COVID-19 shock. And what you kind of see is PC1, significant negative. PC1 is kind of long equity, so it should be negative, and it shows up in the data that way. PC2, also negative. And interestingly, when you combine the two together, PC2 kind of wins out the battle. So PC2 is more of the COVID factor than PC1. PC1 is just probably picking up the volatility in the market as opposed to something specific about how COVID's changing the factor structure. And we kind of confirm this by looking at the difference between PC2 versus using COVID weights versus PC2 using the normal weights from 2019. And what you find is that when you take this spread, so using the exact same returns, you're just changing the weights, You don't find anything for PC1, but you do find the same result for PC2. So some evidence here that the new shocks seem to be describing movements in asset returns, global asset returns as by their factor structure, as by the systematic factors during this period. Also, we said we have a cross section. We've got the Ravenpack news for each country. So what we do is we take the high frequency data, we take the the asset I, equity, fixed income, or FX, country J, and we know the betas from the high frequency data. We also know the PCs, obviously, from the weights. So we can theoretically calculate the high frequency, we can calculate the systematic return component using the high frequency betas and the PC returns. And what we do is we calculate that the systematic factor return component of equity, fixed income, and exchange rates across countries, and we regress that on the we regress that cross-sectionally pooled time series on the new shock in each country. So US equity factor return component will be regressed on the US specific COVID-19 shock from the news source. So we do this cross-sectional analysis. For equity, we sort of know the results should be negative. Fixed income, it could go either way. You could argue that if COVID-19 is bad for the economy, interest rates will be low, inflation will be low, bonds will increase. That would be a positive number. But you could also argue, like in Italy, maybe you got increased fiscal problems, worse credit, and you could get a negative coefficient. So it's not necessarily positive, but we do have a positive here. And on FX, again, it could go either way. We have the FX structure changing with PC2, but maybe ex ante, you might expect it to be negative, right? A country that has bad news, exchange rate's going to get weaker. So we have this kind of cross-sectional analysis along with the time series analysis that seems to link the shocks. Yes, Larry, that is right. It is University of Washington. I just tried to do it quickly. We also do something, that's on the changes on the index, new shocks. We also say you can look at the level of the index. Suppose the level of the index is capturing which countries are more exposed to COVID than another country. So countries that have a high level of the index are countries which are more exposed to COVID. So we take the betas from each individual country in the equity, fixed income, and FX markets, and we correlate that with the index level in that country. And you do find what you may have expected given our data, which is on the PC1, the betas of each country load with their news index. So if you're more exposed to COVID, you have higher betas for your equity and fixed income. And on beta 2, if you're more exposed to COVID, you have higher FX betas. So that's, again, a confirmation that you're getting some relationship between the news and the factor return structure. Okay, I'm actually running a little bit out of time, so let me go through this forecast error stuff. I think this is kind of interesting. We have a kind of a cute result, and I'll probably get just to a little bit of the implication for portfolios. So here, what we do is we take the log growth and death rates across different countries starting in March where the data starts through the end of June. And we take the forecast from the Imperial College, which is what we're using, over the current death. And so that's a forecasted death rate, plus the factor return in that country. And this is the table. So let me just highlight a few things. First of all, not surprisingly, when you regress the log death rates over the next week on your forecasted death rates, you get almost a coefficient of 1, and you get pretty high R-squared. It should be, right? Because we have a pretty good idea how many people are infected, pretty good idea about the distribution in the population across age, and also some historical data that tells you a little bit about how successful they are at treating COVID-19. So you find, a pretty close relationship between the forecast and the death rates. What's interesting is when you include asset returns, you actually get significance for like equities. So meaning that the equity return of a country helps improve the forecast a little bit of the death rate the next period. And you might expect it could have happened 1 week earlier, or it could have been 2 weeks earlier, or 3 weeks earlier. So you have financial markets telling you the right sign, it's negative, and some of them significant, not a huge increase in R-squared, but is telling you something maybe about, you can use that to improve your forecast. So equity markets are smart. You also see it, as we know, fixed income to FX is less direct relationship. So you see it popping up in a few of the lags. Tough to know exactly how to interpret that, but more than you might expect, randomly. Final comment on the forecast errors. If you take the contemporaneous, if you say, look, Imperial College has a great forecast, and you can't do better. So you take the actual difference of death rates minus the forecasted death rates, and you correlate that contemporaneously with returns on equity, fixed income, FX, you get kind of significant results. And again, equity, which is a very obvious relationship, it's strongly kind of significant. There's a couple of papers out there that say you could look at the forecast errors of their own models to forecast stock returns. We don't see it here. So it's not significant here. So we don't see that lead lag relationship that others have found. Okay, that's, I'm almost out of time. So I'm going to skip the portfolio implications and tell you a little bit about some other research that we're getting. Even though some of you may be interested in the portfolio stuff, you can get that from the paper. Let me just show you one thing. When you take an equity portfolio, dollar denominated, you take a fixed income portfolio, dollar denominated, an FX portfolio, which is like the dollar basket, and you regress that in each of the bye weeks on PC2, which is where we think the COVID factor, you will see a flip in sign for equities, a flip in sign for fixed income, and a flip in sign for FX. And you see it in the bye weeks 5 through 7 and 12. So there is something going on, in those rampant peak periods that's telling us something about how the relationship between portfolios and factors are taking place. So let me go to, let me tell you one other result, jumping one other result, and then I'll just end. So we, I haven't shown you it here, but it turns out that the systematic risk shoots up during this crazy bi-week period. So a lot of the variation in these portfolios is coming from systematic risk. So perhaps not surprisingly, because the systematic risk is increasing the volatility is increasing dramatically. It is what's driving a lot of the variation in equity, fixed income, and FX portfolios. So one thing we thought is, like, if you were trading or doing a trading strategy, and you wanted to get rid of that systematic risk and just bet on the individual assets, your information about the US versus Japan versus Italy or whatever, you could imagine hedging out that systematic risk. It turns out that in most periods, normal periods, that hedging works pretty well. If I use the current beta of the equity, fixed income, and FX as my forecast of the next period's realized beta, my idiosyncratic volatility from the ex post versus the ex ante is pretty close, not that different than one. Maybe you're off by 10%, 20%. You get rid of a lot of the systematic risk. Not so during the COVID period. The factor structure is changing so much, you're hedging it that way. Your ex ante guess from 2 weeks earlier for today is just way, way off. So when you really want to hedge systematic risk during the crisis, it doesn't work. And so that's a problem. And it shows up in global financial crisis and shows up for Brexit as well. It's very difficult to hedge out that risk. It's kind of not expected. It's unexpected. And it changes so rapidly during this period. You're always a week or two behind. So final comment to end the talk. So sorry for skipping some of that portfolio stuff, is that we haven't shown it here, but we've also done the same analysis for the global financial crisis and Brexit. A lot of similarities, especially with the portfolio stuff. But there are some differences. The structure of the factor structure changes are a little bit different. So that's an interesting question, why that is. What's different about GFC versus COVID-19? The second thing is where you saw a little bit of Italy breaking from the pack, is that the equity fixed income correlations really changed during crises. This is true of global financial crisis, it's true of Brexit, and it's true of COVID-19. And so that's an interesting question to think about equity and fixed income and what's going on in those markets. We've also looked at COVID-related relationships. So we looked at NOK versus SEK exchange rates. So why that's interesting. Norway had a very aggressive approach to battling the virus, strong mitigation. Sweden, as well known by folks, has a more of a herd immunity, let it ride approach. So the question is two very different approaches to tackling exchange rates. Tackling the crisis, what impact does that have on exchange rates? On the one hand, Sweden has much worse health outcomes. On the other hand, Sweden had its economy was still open, so it's had better economic outcomes. What does that do to exchange rates? So I think that's kind of an interesting little case study that we've sort of looked at and got some data on. Also, dollar versus gold. Dollar in this paper, it turns out to be a little bit of a safe asset during the COVID-19 period. That's where we think is going on with the change in the structure. Gold is also, in theory, a safe asset. When you look at dollar versus gold, or a spread of dollar returns versus gold returns, how does that change during the COVID-19 period? So we've also kind of looked at that. And maybe most importantly, what we're currently doing is maybe even more interesting than this, is that we're repeating this analysis using sector ETFs. So we're doing high frequency analysis on sector ETFs for the US. Now we don't have the 24-hour coverage, so that's a big drawback. We only have 9 to 4. But what we find is that there's the ETFs have this market factor and COVID factor. The GFC has a market factor and a finance factor. The COVID factor, we kind of know what it looks like, right? We've seen it. It's, technology on one side and energy and finance and old economy on the other side. So it's kind of, and then we look at the economic links that these sectors have, and the economic links changed dramatically during GFC in terms of the finance factor, and they also changed dramatically in terms of the COVID factor. So there are certain companies that look like they would really be impacted by COVID. There are certain companies that would really be impacted by a financial crisis. And that seems to hold true in the data. We haven't finished this analysis yet because we wanted to sort of have portfolio implications, and we haven't yet done that analysis on different investment styles. Okay, I blew through that pretty quickly, but that's it. And I guess there's now, there are some questions. Sorry, Kos and Jakob, but Amir can answer them now.
So let me just first step in here. So thanks so much, Matt. That was very interesting. You gave us a lot to think about. I have a bunch of questions, and I think there are probably a bunch of other questions there too. So why don't we formally say thank you and then go to a question period for people who have a few more minutes can chat about that. So thank you.
Yep.
And let me ask the first, which is the other thing that's happening so dramatically during this period is we've seen oil prices collapse, and a lot of the differences, at least to me, look like what we might expect as a result of movements to respond to climate change. In other words, we've kind of got this pandemic on top of the climate change factor, and you would expect, I think, to see dramatic changes in both cases, and I think they're kind of similar, but you may not see them until you look more at the sectoral effects. So I think I'll be quite anxious to see what you find looking at the sector ETFs.
Yeah, I guess what we don't have in the sector ETFs, maybe we should add that. We don't have like a green ETF. We didn't add that.
Right.
So, it's not so easy to do that, but for liquidity, et cetera. But I think, for the COVID period, it probably is, right? So we probably could do that. It wouldn't go back to 2007 necessarily,
Right.
but that would be an interesting question.
There are a lot of styled ETFs.
Yeah, I mean, I think the oil, don't think though that the big movements in oil that we saw, and we see massive movements, by the way, in the betas of oil, not surprisingly, to the PCs. I'm not sure that's really climate change, because I think there were two things that went on during that period. There was a massive supply shock with, the Saudi Arabia and some other countries getting together. And then, of course, there was a complete drop in demand. So those two things together, were driving it. So my guess is, even if you had during that period, it'd be interesting because a green ETF, if it is producing energy at some level, the demand would have dropped way for that as well, because no one was consuming energy during this period as much.
Right. I didn't mean this was a result of climate change. I meant that it looks sort of like the same things we would expect to see from climate change.
Yeah. I think that's probably a reasonable. I actually think it's not a bad. I mean, we haven't done that here. There are papers out there that kind of document a timeline of climate change, important climate change news. I mean, you've been involved in some of this research, but through textual analysis. But there's also some papers that have looked at there are big climate change type meetings and events where a lot of information gets released. It would be kind of interesting to kind of look at high frequency around these periods to see whether something pops up. I think Jakob had a question and Kos is a question. Sorry for missing that, guys. I don't know this. Can they speak or are they?
Yes. Very, very interesting paper, Matt. Now, I have a question, though. You look at a COVID news index or a death index and so on, but the economic effects may be also affected by things like lockdown news, relief effort, how they're going through the Congress or whatever. So, I have some preliminary work where we find this kind of sort of, related economic news, they're getting reflected, at least in our analysis, they're getting reflected in the option markets or derivative markets, as opposed to the COVID news or the health news has a big impact as well on both markets, but a big impact on the stock markets. So I don't know whether you're able to also get, using similar techniques like textual analysis, get a sense of the effect of related news.
Yeah, the reason why we did it this way was because our view was that the change in the index was maybe unexpected. So it has that nice property a little bit. It's not highly correlated. We also looked at social mobility index, which is related to lockdowns, and there's cross-sectional variation there. But there we don't know, like that's not unexpected. So we can't really know that, we don't have the timing of the news. So if there was like a textual analysis that figured out that, oh, we're doing more social mobility, like less social mobility than we did before, that would be, I think even a more direct.
Yeah, but in terms of timing, Matt, something like a Google search index, that you can fine tune to locality and time, precisely if you want. So anyway, that's just
I don't disagree with that. I think that just for us, it was a simple way to maybe measure unexpected news, and maybe other ways to do that, which are even better. But it was, I think it's a little bit trickier on the other stuff, maybe more informative.
I agree. Also, you needed news across different countries and so on. So your span is big. Yeah,
it's a good idea. It's a little trickier, but worth looking into.
Thank you.
Jakob, did Jakob have a question?
Okay, first, it's very interesting and very rich paper. Second, I liked it. And second, you had a model with betas on the right-hand side, and you could perhaps use it to do cross-section regression of all the assets that you have on these betas, like Farmer-Macbeth type, and then period T coefficient is actually the risk premium, and you may want to trace the risk premiums to see how they change over time. That's just a suggestion.
Yeah. I mean, I guess
you have it already.
Yeah, I mean, there are two ways to do it, right? One is to look at I think that's probably a better way to do it, because our mean of PC1 is minus 54% over the COVID period, which obviously is not the risk premium. The risk premium is going to be positive. But we could do that over the 14-year period. And, that's probably going to be a better way of estimating it than just looking at the return on the PC1 over that 14-year period. So that's a good idea. We've not thought about that. And we could also look at it over the COVID period, that maybe you get a more reasonable estimate. So thanks for that. That's a good idea. There's a lot of, the paper's getting very long, yes. But that seems like a worthwhile, that's a worthwhile.
So Matt, let me also ask another question. It's well known, I guess, that correlations tend to rise when volatility goes up.
Yep.
And your factors are essentially uncorrelated, but they're uncorrelated historically rather than necessarily going forward. So it might be that you still have that same kind of effect.
Unfortunately, our factors aren't quite uncorrelated because we're doing the PC in correlation space, but obviously real world is the invariance covariance space.
I see.
So that does increase. That does make them correlated. To do that, we did that because of equity so dominant in terms of volatility. We sort of wanted to understand how the correlations across the assets were changing. So it's not quite, it's not completely what you might expect that you might do with like stocks, for example, where they have roughly similar volatilities. But I do think it's an important point that sometimes people don't think about is the reason why correlations go up is because they're exposed to the factor, and the factor becomes more dominant.
Right. Exactly.
So yeah, so that's sort of what we find here, and I think what was kind of unique finding, I think, at least for the COVID period, and also for the global financial crisis period, when the crisis kind of peak, like is at its worst, you would have thought we could hedge that risk out, but the betas are changing so rapidly during that period, you can't really do it. They flip signs, they act in ways that maybe we wouldn't have expected ex ante. So something else is going on as well. It's just not the variance of the factors increasing. The relationship to that factor is also changing, and that makes it difficult to, the correlation's still there, but it makes it difficult to hedge out.
Right. Well, I think there is a common experience that hedges don't work so well when volatility goes up. They don't work as well as you expect. I mean, you sort of need to overhedge, which costs you a lot in the calm times, and then might serve you to improve your hedge when it gets volatile.
Yeah, so that's, I mean, it's obviously that's partly related to it also, but here it's even worse because the sign switch. So I thought I was positively related to PC2, but I'm actually negative ex post.
That there is such a sharp turnaround in the equity markets. I wonder if your biweekly period might cover two sides of that.
Yeah, it could. I mean, it shows up in the GFC also, and a little bit of Brexit. But yeah, you might be right. We had 1 week, or 3 days.
Yeah, right.
Yeah, but
or which bi-week you had might
be
a bit different.
Throughout the entire 2 months, the 4 bi-weeks, you're really off on the hedging.
Yeah.
So it's changing rapidly, that's for sure.
Well, I think this is great, and it opens us to lots of new questions that.
And I would like to say it's not
be nice to know the answer to.
Yeah, it's just not, even though we focus on COVID here, I think it's kind of an interesting question just generally, right? I think it's an broadly interesting question about global aggregate assets, what drives them, and Jacob's comment about the risk premium is well taken. We don't really know a lot about the global, asset return structure. We kind of think of the market out there, but we don't think about these other assets which are clearly coming in. So I think it's an interesting, it's interesting beyond the COVID. Obviously the COVID is kind of, everyone's interested in that right now, but I think it may be like the equity fixed income relationships are really,
Well, that's not so well understood either.
No, it's not. But the high frequency kind of tells you, at least the realize, it's not just COVID period. This happens. This changes in these periods, and so it'd be interesting to understand why.
Well, I'm going to have to go now. I think Dick and I have another meeting. So thank you so much. And
thank you.
I don't know whether anybody else wants to stay on. I'm afraid if I go off, it'll close it down, but We'll see. Okay, thanks.
Okay, sure.
Thanks, Matt.
Bye.
Bye-bye.
Bye.